So I'm going to do a little bit of valuation basics, the first few slides, to get us all in the same place. For those of you that have done fundamental analysis before, some of this you'll have seen before. For those of you that are new to fundamental valuation, this gives you a good grounding for it, a good basis. Two terms that I want to start with: equity value versus enterprise value. Equity value, think the value of the stock. Enterprise value, think the value of the company. So the value of a company is the value of its debt plus the value of its equity. I'm sure most of you have heard that before. The value of the equity is the value of the common stock times the number of shares outstanding plus the preferred stock, if it exists in the capital structure, times the number of shares outstanding. We'll come back to both of these terms as we do some calculations. So why are we concerned about enterprise versus equity value? Well, we can determine either one of them directly. We can determine the value of the equity in the company, or we can determine the enterprise value of the company and calculate the equity value from that. The discount rates that we use on cash flows will differ. The equity value per share is really what we want to know. What do we think this company is worth compared to where the price that it's trading at? I'll also make a quick note the difference between book value, which is the value that's shown on the balance sheet, and market value, what we think it would sell for or what it has sold for.